Gold prices remain elevated and the supply and demand risks continue to weigh on oil prices. But joining me now to discuss his take on the commodities market and the investors' expectations from it is Eugen Weinberg, Head of Commodity Research at Commerzbank. Eugen, looking at the bigger picture and economic prospects going into 2013 and of course a situation for commodity prices, do you believe we are coming to the end of the commodities so-called supercycle? Or do you think it's even more important to focus on the dynamics of each individual commodity rather than the broader supercycle?
I don't think that the supercycle is already over, as well as I don't think that the economic prospects for the next year are so dismal as it is probably looking for many market observers at the moment. Definitely, the growth this year will be relatively low, but I think that looking forward, we might see not only the emerging markets pushing forward, but also the Western world recovering somewhat in the year 2013. I think that especially for the commodities, it's very important to understand that a part of this year's slowdown in commodity demand in China was orchestrated by the Chinese government over in the second quarter of the next year. We are likely to see more economic stimulus from China as well, pushing also the commodity prices up. So I think that supercycle is far from over, but it definitely makes sense to look at the later stages of the commodity supercycle, at the dynamics of each particular commodity, but the commodity upward trend is likely to stay intact as well.
Well, gold prices recently posted the best quarterly gain in 2 years thanks to financial stimulus from major central banks. But what do you think is going to be driving gold going forward? Is it economic risks? What upside do you see? And also, are these prices we're seeing now sustainable?
It's very interesting that economic risks, at least over the course of the last 12 months, didn't prove to be a positive catalyst for the gold price. There are several reasons for this, and I think that especially the high speculative interest in gold, which we witnessed in the second half of last year, was responsible for this, and with investors leaving the market, the gold price or gold again returned to its traditional role of risk-averse mechanism of insurance and alternative currency. I think that this will be what will be driving the gold prices in the future. And gold prices, which at least in euro terms and Swiss franc terms, rose to the all-time highs just over the course of the last couple of days. I think it's likely to continue its path, definitely mostly thanks to the more monetary stimulus from the central banks, and I think this is definitely will be the most important major driving factor behind the gold prices, but also the fact that the central banks themselves are trying to invest or diversify their forex reserves into gold is likely to be also a supportive factor.
As we know, each metal has its own outlook, especially when it comes to supply. If we take, for example, iron ore, prices have tumbled while copper prices have remained buoyant. Do you see any pickup in iron ore prices? And for the more bearish investors and analysts, they're questioning whether it's just a matter of time before copper will take a tumble and catch up with the other metals. Do you agree?
No, I disagree, definitely. I think it's the other way around, that the bulk commodities like iron ore are following the exchange-traded commodities like copper. And that's what we witnessed this year as well. As you rightly mentioned, the iron ore prices tumbled from the likes of $140 per ton towards $80 per ton only recently, and it was really just in the contrast to the relatively stable performance of the rest of the metal sectors. But then the fortunes of the iron ore markets turned suddenly, and the iron ore prices rose by some 30% in just a matter of few days, and they really caught up with the copper prices. That's why I would suggest that the iron ore prices would rather catch up in the future more with copper, and copper is likely to be a leading indicator not only for the economy in general, but also for the metal prices and for iron ore prices in particular.
In terms of oil prices, what are the big risks? Is it increased supply and falling demand? Also, given geopolitical risk and tension in the Middle East, where do you see oil prices in both the short and slightly longer term?
It's actually a billion-dollar question. What is driving the markets and where the prices will be moving? At the moment, we are definitely seeing very ample supplies on the market, despite the sanctions against Iran. Many other producers increased their production at the cost of Iranian oil production curbs, and therefore the markets are staying well supplied. I see mostly the risk right now on the supply side and not so much on the demand side. We know that the demand is weak. We know that the demand is not likely to recover in the medium term and even next year, but I think that the most of the risks right now are on the supply side. And as you rightly mentioned, if something happens in the Middle East, that might lead to a very strong correction on the price side. Even a small disruption, even a very short-term closure of the Straits of Hormuz might lead to the oil prices increasing towards $150 or even above. But definitely, in the current prices of around $112 per barrel of Brent, there is already some geopolitical premium inside. So the price without any geopolitical risk would be probably trading much lower by $10 or even more below the current levels. But it's questionable whether $10 is enough as a geopolitical premium if the situation escalates.
Eugen, thank you very much for your comments there. Pleasure to have you on DukascopyTV. Now, I'm afraid that's all we have time for the moment, but do stay tuned to DukascopyTV for more financial news and updates. For the moment though, goodbye.